All right, this is a interesting read, and you kind of got to go below the surface here and understand moves versus retracements and what the market's trying to do and where it pisses off the other side. So there's always people that want it to go down and want it, and people who want it to go up. The people who want it to go down are shorts. The people who want it to go up are longs. You should know that, right? Not just bulls and bears. I'm talking about people with positions, longs and shorts. There's always longs and shorts in the market, and we know what the shorts want. We know what the longs want. Now, when you look at a market, what are the things that you could see that are somewhat obvious and with respect to what it's done? It's done this. Just move to retracement what it's done. It's made a move to the downside. And now people are looking at this move and thinking that it's going to get a retracement, which it could, and then have a continuation, because every book that people read, markets look like this, and they think it's going to look like that and be simple. So that's what they're anticipating. And there's nothing wrong with that. So here's the move. Here's the retracement possibly, and they're looking for a continuation down. Maybe they're looking for a continuation down from there. Maybe they're looking from there. But if you look at this as a move, and then you look at the bounce, in this case, as the retracement, some are looking for continuation. Some might be looking for it to retrace 100% of the move. But you got to separate with your eyes the move from the potential retracement. Those are looking for this to happen. Some are looking for this to fail and maybe run up. If there are more people looking for the retracement and the subsequent continuation, generally it's going to be harder to work. So then what you do see is a moment where it works, or it's starting to work, I should say, and then wham, it comes right back. Let me play it and show you what that looks like. If you're watching this bar right in here, how fast it went down. So it's getting people to think, finally, we're going to break this swing low and this swing low, and we're going to test this swing low down in here, which is the bottom of this move. All right. But a funny thing happens. There's the move. This is the one I'm talking about. You could say this move right in here and then this bar. So shorts are now thinking, got it, right? And they might have it. They might have it. This might be, it comes up and it comes back down. And this is finally that move that they read or seen in a book. It's not as perfect as it does this, but it's going to go down and have that continuation. All right. And it might. So you got a lot of shorts that are probably thinking that that is the story that's going to play out. And a funny thing happens. Doesn't always. So you want to be on top of it and read it. You start to get some shorts to also enter, maybe late down in there. Number one. Number two, you look at this being a little miniature move from here to here, because it was something that you could be able to see. You understand that too many shorts make it hard to go down. And so we start to walk back up. Let me fast forward it, speed it up, starts to walk up. But the moment it gets right back into here, and you hear me or see me, these yellow markings are what I'm putting in real time. You could see, let me back it up, that line that goes in there, all that highlight that I'm doing in real time is, listen, this is where the market went down to. You got to be careful up in here, because this kickback right in here is now taking the, oh, it was going to go down. What's going on in here? And it becomes a bearish to bullish moment. We call it B to B. Market was bearish. You got all these shorts excited. They want it to go down. It went down fast. They think they're going to attack that, and it's going to be that retracement continuation. And what happens? You see the top up in here form. You know you got shorts that are really going to get pissed and start to chase it. And now this becomes predictable instead of random, instead of a guess. But you have to go deeper. You have to understand what the market and what participants are trying to do, and what kind of a job is it doing, and where are they stuck? Where are they pissed? Where are they chasing? And the fact that you can then qualify, it's got a very small chance to continue when you see the shorts build up and come in late. So a lot of people, when they start trading, generally reach and are late. They use price to predict price. Price goes down, they're bearish, they short, and they're late. The market rallies, they're bullish, they're long, they're late. You got to predict the move before or early on in the move. You can't let the move predict the move. But most people get caught up in doing that. So all these shorts turned our laser from green in here to red in here. And of course it goes up. It just has a better chance of going up. So have that make sense to you. Replay this video. Understand moves versus retracements.